It is 3 a.m. in the penthouses of Manhattan, the glass towers of London, and the neon-lit districts of Tokyo. The world is asleep. But inside the silent hum of server rooms, the math is already changing. While you sleep, a ghost is moving through the global wires. It isn't a virus, and it isn't a hack. It is something far more primal, the sound of a billion digital promises beginning to break. Tomorrow, the world as you know it, the value of your savings, the stability of your job, the very price of the coffee you'll drink, is about to enter a free fall. This isn't just a bad day on Wall Street. This is the anatomy of a collapse. To understand why the world is crashing tomorrow, we have to understand why it felt so safe today. For the last few years, the market has been a bull. Prices didn't just up, they soared. Your neighbor became a trading genius overnight, and your social media feed was flooded with 20-year-olds in Ferraris. This is the displacement phase. It starts with a genuine breakthrough, maybe a new AI technology or years of easy money from central banks. But there is a law in finance as certain as gravity. The higher the peak, the thinner the oxygen. As the market climbed, the greater fool theory took over. You didn't buy that stock because you thought the company was worth its price. You bought it because you believed a greater fool would buy it from you for even more tomorrow. But tonight, the fools have run out. The crash doesn't start with a bang. It starts with a whisper. In the pre-market hours, institutional algorithms, the algos, detect a slight imbalance. A major bank in Europe announces it is restructuring due to liquidity concerns. It sounds boring and technical, but to the algos, it's the scent of blood. Imagine you bought $10,000 worth of stock, using only $1,000 of your own money, borrowing the rest. This is leverage. It's a superpower when prices go up, but when they drop even 10%, your original $1,000 is gone. The broker calls for their money a margin call. To pay them, you must sell. But everyone else is getting the same call at the same time. Everyone is selling. No one is buying. When the bell rings at 9:30 a.m., the trickle becomes a flood. Within the first 60 seconds, the Dow Jones sheds 800 points. The red numbers on the screens aren't just data. They are the evaporation of trillions of dollars in retirement funds and college savings. This is herd mentality. Humans are biologically wired to follow the crowd to survive. In the jungle, if everyone runs, you run. On Wall Street, if everyone sells, you sell. By mid-morning, the circuit breakers kick in, pausing trading for 15 minutes to calm the market. It has the opposite effect. In those 15 minutes of silence, the fear doesn't dissipate. It ferments. Investors stare at frozen screens, unable to exit. The uncertainty turns into loss aversion. The psychological pain of losing $100 becomes twice as powerful as the joy of gaining it. People aren't thinking about long-term value anymore. They are thinking about survival. In the 1929 crash, it took days for news to travel. Today, it takes microseconds. High-frequency trading programs are now the dominant force. These machines are programmed to sell if a certain price level is breached. When the machines see other machines selling, they sell faster. It's a digital avalanche. The flash crash phenomenon occurs where prices drop so fast the human eye can't even track the candles on the chart. By noon, even the safe stocks, the Apples and Coca-Colas, are being dragged down. Not because they are bad companies, but because investors need liquidity. They are selling their winners just to cover the losses on their losers. In a crash, the correlation of all assets goes to 1. Everything falls together. By 2 p.m., the crash leaves the screens and enters the home. This is the wealth effect. When people feel poorer because their portfolio is down, they stop spending. They cancel vacations and delay new cars. When spending stops, companies lose revenue, leading to layoffs. This is how a market crash becomes an economic recession. The market is a mirror, and today that mirror is shattered. But before the first sell order was ever placed, the architecture of this crash was built in plain sight. We saw the warning signs, the euphoria of the fear gauge being too low, and the inverted yield curve where the bond market signaled that the immediate future was more dangerous than the long term. We ignored the negative divergence where only a few massive tech stocks were propping up a failing market. And then came the black swan, that unpredictable event like a bank collapse or a geopolitical flare-up that hit a fragile system. But as the sun sets on the worst trading day in a generation, a few people are doing something different. Crashes are the great transfer of wealth. While the herd sold at the bottom out of fear, the smart money was waiting. They know that a stock market crash is the only time the world's greatest companies go on a clearance sale. History shows us that every single crash 1929, 1987, 2008 was followed by a recovery that reached even higher peaks. From a distance, these crashes look like tiny blips on a giant mountain of human progress. Tomorrow will be hard. Tomorrow will be loud. But for the educated investor, tomorrow is the greatest opportunity of a lifetime. The market is a device for transferring money from the impatient to the patient. So when the bell rings tomorrow, will you be a victim of the panic or a student of the cycle?